It finally happened. We now have details on Donald Trump's proposed tax cuts, and this could mean serious savings for many of you. He's outlined 6 major categories that might undergo significant changes. So let's break down what he's proposed and how it could impact your finances, and what you might expect moving forward. This could be the most substantial tax shift we've seen in nearly a decade. Back in 2017, Trump signed the Tax Cuts and Jobs Act, and this reduced taxes broadly, cutting corporate rates and offering notable benefits for the self-employed. But these were set to expire by the end of 2025, unless extended. Now, Trump is back with a fresh plan, and here's what's on the table. First, he wants to eliminate taxes on tips, Social Security benefits, and overtime pay. Starting with tips, the proposal could redefine how tips are treated, possibly exempting them from income tax or allowing deductions when filing taxes. This idea isn't entirely new. Senator Ted Cruz suggested something similar in 2014, and if it passes, a $5,000 tip could mean a $5,000 deduction, effectively eliminating taxes on that income. However, this raises questions about fairness to non-tipped workers and whether some might restructure income as tips to benefit. Additionally, since many tipped workers already pay little to no federal income tax, the broader impact remains to be seen. It might not have any effect at all. There are also concerns about how this change could affect tax credits for low-wage workers. Some analysts argue that increasing reported tip income could result in reduced eligibility for credits like the Earned Income Tax Credit. Moreover, would self-employed individuals find loopholes by classifying income as tips to benefit from this exception? It's likely any final legislation would include provisions to prevent abuse, possibly capping deductions based on a percentage of gross income, or phasing them out at higher income levels, kind of like the step tax rates. Next, no federal income tax on Social Security benefits. This is a no-brainer. Currently, up to 85% of these benefits can be taxed depending on your income. Trump wants to change that, potentially boosting retirees' disposable income. While this could help those with higher incomes, it also raises concerns about Social Security funding, especially since projections suggest that the funding might face shortfalls by 2035. Any revenue loss might require compensatory tax hikes or spending cuts elsewhere. And interestingly, about half of Social Security recipients already pay no federal income tax on their benefits because their overall income is below the taxable threshold. This means that the proposed change would mainly benefit higher income retirees. And while this could stimulate the economy by increasing discretionary spending and bumping up those Corvette sales, it could also accelerate the depletion of Social Security reserves, which are already starting to dwindle and are going to run out. This could necessitate future policy adjustments. Then there's the proposal to eliminate taxes and overtime pay. Currently, overtime is taxed like regular income, but Trump's plan could change that, encouraging workers to put in more hours without worrying about extra tax burdens. While this could benefit hourly employees, many salary workers wouldn't see a difference at all. Plus, some companies might cap hours to avoid having to pay overtime altogether. The idea is that removing taxes on overtime could incentivize employees to work additional hours, potentially addressing labor shortages in certain industries. In states like California, where double time pay applies after 12 hours in a day, the impact could be even more pronounced. Trump also aims to renew key parts of the 2017 tax cuts, like keeping the top tax rate at 37% instead of reverting to the 39.6%, maintaining business-friendly deductions like the 20% pass-through deduction for LLCs, and preserving generous estate tax exemptions. This continuation seems likely to pass since it essentially keeps the current structure intact. The pass-through deduction, in particular, has been a significant benefit for small business owners, allowing them to deduct up to 20% of their business income. Now, renewing this provision would provide ongoing tax relief for entrepreneurs, freelancers, and other self-employed individuals. A lot of mom and pops would greatly benefit from this. Additionally, maintaining the double estate tax exemption could reduce the tax burden on wealthy families, potentially influencing estate planning strategies. Another significant change was an adjustment to the SALT cap deduction, SALT. Before 2017, state and local taxes were fully deductible, but the Tax Cut and Jobs Act capped this at $10,000. Trump's plan may raise this cap, which would benefit residents in high-tax states like California and New York, though details are still emerging. The SALT cap has been a continuous issue, particularly for taxpayers in states with high income and high property taxes. Adjusting the tax could provide a substantial relief for these individuals, potentially reducing their overall federal tax liability. However, critics argue that such changes primarily benefit high-income households, as they're more likely to itemize deductions and exceed the current cap. Trump is also targeting tax breaks for billionaire sports team owners. Currently, they can deduct significant portions of the purchase cost of the team as business expenses, even if their teams are highly profitable. Ending this loophole could limit large deductions that seem out of place compared to traditional business write-offs. This deduction strategy often involves claiming paper losses through depreciation and other accounting methods, even when the team is generating substantial revenue. Eliminating these tax breaks could lead to higher tax bills for wealthy team owners, potentially impacting the economics of professional sports franchises. The carried interest loophole is another focus. This allows private equity and hedge fund managers to pay lower capital gain taxes on income that would otherwise be taxed at higher ordinary income rates. Trump wants to close this loophole, a change that's been discussed for years but never fully implemented. Closing the carried interest loophole could significantly increase tax revenue for high-earning investment managers. Currently, they benefit from the lower long-term capital gains rate of income derived from managing other people's money. Reforming this provision could create a more equitable tax system, though it may face strong opposition from the finance industry. They're not going to be happy about this. Finally, tax cuts for products made in America are on the horizon. While specifics are a bit vague at this moment, the goal seems to be encouraging domestic manufacturing through tax incentives, either for businesses or consumers buying American-made goods. The intent is to strengthen the U.S. manufacturing sector, create jobs, and reduce reliance on foreign supply chains. Of course, all of this is just a proposal for now. It has to go through Congress, has to face debates and amendments and votes in both the House and the Senate before potentially being signed into law. Given the current political landscape, a modified version could become law as early as maybe 2026. The legislative process involves multiple stages, including committee reviews and public hearings and potential revisions. Bills often undergo significant changes before final approval, and people slip in all their other riders. Influenced by negotiations and lobby firms, various interest groups. Even with Republican control of both chambers, bipartisan support may be necessary for certain provisions to pass. Otherwise, they could die due to filibuster. Another critical consideration is how these tax cuts might affect the federal deficit. Reducing revenue without corresponding spending cuts could increase the national debts over time. Supporters argue that economic growth spurred by tax cuts could offset revenue losses, while opponents warn that rising deficits might lead to future fiscal challenges, including potential cuts to essential public programs or higher taxes down the line. Now, leave a comment down below letting you know how any of these tax cuts might affect you. If you enjoyed this video, please give it a like, subscribe to appease the YouTube algorithm. Thank you so much for watching, and I'll see you next time.